Okay, let's unpack this. Ever looked at a company's financial report? Seen a big profit, maybe, but then looked at their bank balance and thought, hang on, where's the actual cash?
Or the other way around, right? Lots of cash, but the profit looks tiny.
Exactly. And the key to understanding that kind of disconnect, it often comes down to one big idea: accrual basis of accounting.
It's pretty fundamental.
It really is. It's how most businesses, really measure their performance over time. But honestly, it can feel a bit abstract until you see it working.
Yeah, definitely.
So this deep dive, we're drawing heavily from a really detailed guidance note by the Institute of Chartered Accountants of India. Think of it as our roadmap.
Very thorough one.
Right. And our mission today. Let's try and cut through the jargon, figure out why accrual is the standard, and what it actually means for you when you're trying to understand if a company is, well, truly healthy financially.
Yeah, absolutely. It's the bedrock of proper financial reporting for good reason. It gets us beyond just, money moving in and out. It aims for what the source calls a more accurate picture of performance.
A more accurate picture. Okay, so let's start right there. How does the source define accrual accounting? What's the main idea?
Well, at its core, the guidance note says accrual is about the recognition of revenues and costs as they are earned or incurred. And crucially, it adds, and not as money is received or paid.
Not when money moves.
Exactly. And it stresses this applies right across the board, assets, liabilities, too. They get recognized when they sort of happen, economically speaking, regardless of the cash.
Okay, so it's definitely not about when the cash changes hands. That's the key difference.
Precisely. The simpler way, the cash basis, that only cares when cash comes in or goes out. Simple, maybe, but accrual is different. It's where everything, revenue, costs, assets, liabilities, they're all recorded in the accounts for the period they actually relate to.
The period they belong in.
The period they accrue, yeah. Sometimes it's called mercantile basis, too.
Okay, mercantile basis, got it. That distinction makes sense.
Yeah.
But why? Why add this layer? What's wrong with just tracking the cash? What problem does accrual solve?
That's a great question. And what's interesting is the source really highlights the basic problem. In business, the timing of an event, like, making a sale or using a service, it very rarely lines up perfectly with when the cash actually gets paid or received for it.
Right. Things happen on credit or you pay in advance.
Exactly. So if you only tracked cash, your financial reports could be all over the place, showing huge profits one month and losses the next, just because of payment schedules, not because the underlying business changed. It wouldn't be very useful.
Ah, okay. So accrual is trying to connect the actual business activity, the effort or the accomplishment to the right time period.
That's it, exactly.
Okay.
The guidance puts it really well. It says the goal is to relate the accomplishments, measured in the form of revenue or income, and the efforts, measured in terms of cost expense, so that reported net income measures an enterprise's performance during a period instead of merely listing its cash receipts and payments.
Wow. Okay. That phrasing really nails it. It's about performance in the period, not just cash flow during the period. Sounds like it smooths things out, gives a clear view of what the business actually did.
It absolutely does. That's where the more accurate picture comes in, showing performance and financial position more reliably over time. Think about selling on credit. It's super common, right?
Yeah.
You earn the revenue when you make that sale, even if the customer doesn't pay you for 30, 60 days. Accrual captures that. It also means you can actually compare performance from one year to the next using proper metrics because income and expenses are matched up correctly.
Makes comparisons meaningful.
Right. And the source also touches on how this helps assess management stewardship, because people using the financial statements need timely, reliable info to make good decisions.
Okay, here's where it gets really interesting, I think. The guidance note uses this great little example. Fictional company XYZ Ltd. They sell a 2-year subscription, let's say, for 2,400 rupees. And the customer pays the whole 2,400 upfront in year 1.
Okay.
So walk us through it. How does just tracking the cash mess things up here?
All right. So under the simple cash basis, year 1, XYZ gets that 2,400 cash. Boom. They report all 2,400 as revenue for year 1. Let's say their costs to provide the service for that first year are 600 rupees.
Okay.
Cash basis report for year 1 shows revenue 2,400, expenses 600, profit 1,800. Looks amazing, doesn't it?
Yeah, massive profit. You'd think they absolutely crushed it in year 1.
Right. But now let's look at year 2. Under cash basis, how much cash comes in related to that subscription?
None. They paid it all last year.
Exactly. 0 cash in year 2. But they still have costs, right? They still need to provide the second year of the service. So let's say expenses are, again, 600 rupees.
Okay.
So Year 2 cash basis report, revenue, 0, expenses, 600. Result, a loss of 600 rupees.
Whoa, hold on. So year 1, huge profit. Year 2, a loss. Even though they're doing the exact same amount of work providing the service in both years, that seems wrong.
It's completely misleading about the actual performance over time. It makes year 2 look like a disaster when really they're just fulfilling the obligation they were already paid for.
Okay, so that's the cash trap. Now, show us the accrual basis version for XYZ. Same scenario.
Right, accrual basis, year 1. They get the 2,400 cash, yes. But how much revenue do they recognize? Only 1,200 rupees.
Why only half?
Because they've only delivered 1 year of the 2-year service. They've only earned half the money in year 1.
Ah, earned. Okay. So what happens to the other 1,200 they received?
That other 1,200, the cash received but not yet earned, that gets recorded as a liability. It represents the obligation to provide the service in the future, often called unearned income or deferred revenue.
Okay, so it's like a debt they owe in services.
Exactly. So year 1 accrual picture. Revenue 1,200, expenses 600, profit 600 rupees.
A smaller profit than cash basis showed for year 1, but that feels more real somehow, more tied to the actual work done.
Much more real. Now fast forward to year 2, accrual basis. Does any cash come in from this customer?
Still no.
Correct. But do they provide the service?
Yes, the second year's worth.
Right. So they earn the other 1,200 rupees in year 2. That liability, the unearned income from year 1, it goes away and it becomes revenue for year 2.
Ah, the liability turns into revenue as the service is delivered.
Precisely. Expenses are still 600 for year 2. So the year 2 accrual picture, revenue 1,200, expenses 600, profit 600 rupees.
Wow. Okay. So 600 profit in year 1 and 600 profit in year 2. That's consistent. It perfectly matches the fact they delivered half the service each year. That's the aha moment.
Exactly. Accrual shows the performance linked to the actual economic activity, the earning process, not just when a lump sum of cash happened to arrive. It gives that more complete picture the source talks about.
Much more complete. It smooths out the bumps caused by cash timing. Okay, so we see the principle. Recognize things when earned or incurred. How does this actually work then when we look at the building blocks? Assets, liabilities, income, expenses.
Yeah, Section 4 of the guidance gets into this. And the key idea, again, isn't cash. It's whether something meets the formal definitions of an asset, a liability, income, or an expense, and the recognition criteria.
Recognition criteria, like what?
Basically, is it probable that some future economic benefit will flow to or from the company, and can you measure the amount reliably? If yes, then you generally recognize it.
Okay, so let's take as things the company owns and liabilities things it owes. How does accrual apply there, regardless of cash?
Well, the source explains they get recorded when they meet those definitions and criteria. Think about buying, say, a big machine for the factory. You might receive the machine today, start using it, but maybe the payment terms are 30 days.
Right.
Under accrual, you recognize that machine as an asset today. Why? Because you control it, you expect future benefits from using it. And at the same time, you recognize a liability, maybe accounts payable, because you now owe the money for it.
Even though no cash has actually been paid yet.
Exactly. The economic event, gaining control of the asset, incurring the obligation to pay, has happened. Or think back to our XYZ example. Getting that 2,400 cash upfront didn't create income immediately. It created that liability, unearned income, because XYZ owed a service.
Got it. You record the substance, the asset gained, the debt incurred, the obligation created, even if cash flows later or earlier. What about the other side? The income statement stuff, income and expenses.
Similar logic. Income gets recognized when it's earned, when the business has essentially done what it needed to do to be entitled to the money. The source links this to formal standards like India's AS9 on revenue recognition. Usually that means when risks and rewards of ownership transfer for goods or when the service is performed.
So delivering the product or doing the work triggers the revenue, not getting the payment.
Correct. And for expenses, accrual uses a couple of important ideas. One is the matching principle.
Matching.
Yeah, trying to match expenses with the revenues they helped generate in the same period. The classic example is cost of goods sold. When you sell some inventory and recognize the sales revenue, you also recognize the cost of that specific inventory as an expense in the same period.
Makes sense. You match the cost to the sale. What else?
Another key concept is systematic allocation. Think about that machine we bought. You don't expense the entire cost in the year you buy it.
No, you spread it out. Depreciation.
Exactly. Depreciation is an accrual concept. You're systematically allocating the cost of that asset over the periods you expect to benefit from using it. You're matching the cost to the periods it helps generate revenue in.
So depreciation isn't about cash leaving the building each year.
Not at all. It's purely an accounting adjustment to spread that initial cost. Then you also have costs that clearly benefit just the current period costs, like, say, the monthly office rent or salaries for that month. Those are expensed in the period they're incurred.
Okay, but what if I, say, pay my office rent for the whole year up front in January?
Ah, great question. That's a perfect accrual scenario, that big cash payment in January. Under accrual, it's not rent expense for January. It creates an asset.
An asset. Paying rent creates an asset.
Yes, usually called prepaid rent or prepaid expenses. It's an asset because you've paid for a resource the right to use the office that will benefit you over future periods. Then, each month, you'd recognize 1/12 of that total payment as rent expense and reduce the prepaid rent asset.
So you expense it as you use up the benefit you paid for.
Exactly. And the flip side works too. Let's say you use electricity in December, but you don't get the bill, and you don't pay it until January.
Mm-hmm.
Under accrual, you have to recognize the electricity expense in December because that's when you use the electricity, when you incurred the cost. And since you haven't paid yet, you also record a liability accrued expense or outstanding expense.
So you record the expense when it happens and the liability because you owe the cash.
Precisely. It constantly adjusts things back to the period the economic activity actually occurred, pulling revenue forward or pushing expenses back or vice versa, compared to just tracking cash.
That really paints the picture. Whether it's depreciation, matching, prepayments, accruals, it's all about aligning the financials with the underlying business reality, period by period.
Okay, but what if a company has been using the simple cash basis and needs to switch? That sounds complicated. It definitely involves some work. Section 5 of the guidance talks about this transition. Essentially, you have to make a series of what are called adjusting entries at the point of transition to get the books onto the accrual basis.
Adjusting entries.
Yeah, and the source breaks them down into two main flavors, accruals and deferrals.
Okay, accruals and deferrals. Can you walk me through the difference there?
Sure. Think of accruals first. This is where the economic event has happened, but the cash hasn't moved yet for that event, so you need to record it now.
Like the electricity bill example.
Exactly. You use the electricity economic event, but haven't paid. Cash hasn't moved yet. So you accrue the expense and the liability. Or maybe you did some consulting work right at the end of the year, earned the revenue, but haven't sent the invoice yet. You'd accrue that revenue and create an account receivable asset.
Okay, so accruals are about recording things that cash basis would have missed because the cash wasn't there yet.
Right. You're catching up with the economic reality. Now, deferrals are kind of the opposite situation. This is where the cash has moved, but the economic event hasn't fully happened yet for the period you're in.
Like the XYZ subscription.
Perfect example. Cash came in up front, cash moved, but the service delivery economic event happens over 2 years. So you defer recognizing most of that revenue until year 2. That created the unearned income liability.
Or the prepaid rent example.
Exactly. Cash paid up front, cash moved. But the benefit of using the office economic event happens over the whole year. So you defer recognizing the expense, creating the prepaid expense asset first.
Okay, so deferrals are about taking a cash transaction that happened now and pushing the recognition of the income or expense into the future period where it actually belongs economically.
You got it. And the guidance notes that making this switch, especially figuring out that very first opening balance sheet on an accrual basis, takes careful analysis. You have to find all those assets, liabilities, prepaid things, unearned things that were maybe ignored or misstated under the cash method.
Sounds like digging through the past a bit.
It can be. And they also point out, quite fairly, that the first year after switching might not be perfectly comparable to the old cash basis years. So clear disclosure and explanation is really important for anyone reading this financial statement.
Right. Okay, so we've defined accrual. We've seen why it's necessary. We walked through that XYZ example. We understand how it applies to assets, liabilities, income, expenses, and even how you'd switch over. Let's zoom out again. Why should you, listening right now, actually care about all this accounting detail?
Well, fundamentally, understanding accrual accounting is just. It's key to being able to properly read and interpret formal financial statements. Pretty much any set you'll see for a medium or large business.
It's the language they speak.
It is. It lets you look beyond just the cash balance today. It helps you judge a company's actual profitability over a period, understand its real obligations, see the resources it truly controls, things that cash flows alone might hide or distort depending on timing.
So it's about getting closer to the, I guess, the economic truth of the business.
I think that's a good way to put it. Because accrual is the standard used by pretty much all significant businesses, investors, banks, regulators. Getting a grip on it makes you a much more informed user of that information. Whether you work for a company, invest in one, lend to one, whatever your connection, it gives you much deeper insight into its actual financial health and performance.
Okay, so what does this all mean then? Wrapping it up, accrual accounting. Based on this guidance, it's this foundational principle. It adds a layer of maybe complexity compared to just cash, but it's essential. It's about recognizing revenues when they're earned, expenses when they're incurred.
Right, to give that clearer, more accurate picture of performance over a period.
But here's a thought. As the guidance sort of implies, focusing on earned revenue and incurred expenses means a company can look profitable on paper using accrual accounting, even if the cash from those profitable sales hasn't actually arrived yet. Or maybe they spent a lot of cash on assets that won't be expensed for years.
That's a critical point. Accrual profit shows earning power, the economic performance. But you absolutely, positively still need to look at the cash flow statement. Is that recorded profit actually turning into cold, hard cash that the business can use to pay bills, reinvest, pay dividends?
So there can be this tension, this potential gap between the accrual profit picture and the cash reality. What does that tension tell us? How should we think about that when we evaluate if a company is really, truly strong and sustainable?
That's the million-dollar question, isn't it? Profitability is crucial, but cash is king, as they say. Understanding both and the relationship between them. That's key.
Definitely something for all of us to think about.